All right, let's dive into a real puzzle that's playing out in the markets this week. Because on one hand, we are seeing record highs, a flood of good news. But on the other, some of the smartest minds in finance are quietly sounding the alarm. So, what is really going on here? Let's break it down.
First up, the big headline, the S&P 500 has smashed through a new milestone for the very first time. I mean, that's a staggering 40% surge since just this past April, and it's all being fueled by really positive signs like lower than expected inflation. So on the surface, you'd think things look absolutely incredible.
And this is where it gets interesting. This brings us to the core question of this whole explainer. If the market is hitting these amazing new peaks, why is there such a strong undercurrent of caution among seasoned professionals? Well, the answer reveals a really deep divide in how people are seeing the future. Okay, so first up, let's talk about the first major contradiction. The market seems to have a split personality. It feels like not everyone is buying into this rally in quite the same way. And you can really see that divergence in action right here. On one side, you've got individual retail investors just piling into the market, buying super aggressively. But on the other side of the so-called smart money, we're talking professional fund managers, they're doing the exact opposite. They are quietly selling their positions, rotating into more stable, higher quality assets. It is a classic case of Main Street and Wall Street heading in totally opposite directions. You know, this split isn't just happening among investors. It's happening at the highest levels of global finance. We're seeing what looks like a massive tug of war between the world's two largest economies. On one side, you have the U.S. Federal Reserve, which pretty much everyone expects will start cutting interest rates to keep the economic expansion going. But on the other side, the People's Bank of China is playing a completely different game. They're focused inward, aiming for technological self-reliance and stability to counter U.S. tariffs and trade restrictions. And these two totally opposing strategies are sending massive ripples across the entire global market. And wow, has the market picked a side on this one? Right now, traders are pricing in a massive 97% probability that the Fed is going to cut rates. This belief, this conviction that cheap money will just keep flowing, is exactly what's been pumping air into the stock market rally. So while all that's happening, China is making its own moves to kind of insulate its economy. By focusing on its own internal growth and keeping its production costs low, China is effectively exporting deflation. What that means is cheaper goods are flowing into the global market, putting downward pressure on prices everywhere, which you can imagine really complicates things for the Fed trying to manage inflation. All right, so where does all this tension actually play out? In the assets themselves. Let's move to the battleground and see how this is all building.
This slide just perfectly captures the contradiction. You see the S&P 500 soaring, but at the same time, the actual cash flowing into U.S. stocks has dropped. As BofA analyst Michael Hartnett warns, this just doesn't look like a stable rally. He's basically saying it's being fueled by speculation and easy money, low-interest loans from over 300 global rate cuts, which could be creating some really dangerous market bubbles.
Well, if not stocks, then what? And here, believe it or not, we find a rare point of agreement. Both Ray Dalio and Michael Hartnett are pointing to gold. Dalio sees it as a hedge against the massive U.S. debt and the way the dollar is used in sanctions. Hartnett, though, is even more bullish. He's targeting a wild $6,000 an ounce as a safeguard against a potential AI meltdown, a scenario where an overhyped, overinvested AI sector could just crash spectacularly. Now, while the traditionalists are turning to gold, a new generation of investors is looking at digital assets. This quote from the influential voice, Da Vinci Jeremy, just captures the sentiment perfectly. Despite all the volatility, the belief among the real long-term Bitcoin holders, the hodlers, it is just incredibly strong. But the story here is way bigger than just hodling. Real-world adoption is picking up speed, with entire regions like Africa fast-tracking crypto regulations. And we're seeing the very early stages of what BlackRock's Larry Fink calls the tokenization of all assets. This whole idea that real-world items, like real estate or art, can be represented as digital tokens on a blockchain. I mean, that could revolutionize finance. Okay, so as if all this economic complexity wasn't enough, we have to layer in the one thing that can change everything, literally overnight: geopolitics. I mean, just look at how fast things can move. This timeline shows just a single day. In the morning, new tariffs are announced rattling allies. By the afternoon, tense trade talks with a major rival kick off. this constant potential for disruption is a huge source of volatility for the market. And this brings us full circle, right back to strategy. Ray Dalio connects the dots for us perfectly. He argues that every single time a sanction is used or a tariff is imposed, it kind of chips away at the trust people have in regular government-backed currencies like the dollar. And in all that uncertainty, an asset like gold, which isn't controlled by any single country, becomes this anchor of security. Okay, so we've navigated all these crazy crosscurrents. What are the key things you really need to remember? Let's boil it all down. All right, here are the 3 big themes you'll want to keep on your radar. First, the great divergence, that growing gap between what retail investors are doing and where the smart money is going. Second, the policy tug-of-war between the U.S. and China. And third, the search for safety, as more and more investors look for hedges like gold. So if you pull all this together, a kind of consensus strategy seems to be emerging from the experts. The advice is to diversify your portfolio with international stocks and gold, keep an eye on Bitcoin, maybe use the dips as potential entry points, be really cautious of an overheated tech sector, especially in AI, and above all, pay very close attention to those geopolitical headlines. And that really leaves us with one final big question. In a market this fractured, being pulled in so many different directions by so many powerful forces, is the biggest risk picking the wrong side of the divide, or is it maybe just standing still and not making a choice at all? Something to think about. Thanks for joining me.